As the end of the year approaches, I'd like to talk to you about one way to potentially lower the taxes you pay. It's a technique called tax loss harvesting, and it's designed to help you reduce your taxes on capital gains by selling assets that have lost value. It can be complicated, and it's not always a good idea, so here are three things you should know. First, determine whether you have a short-term or a long-term gain. If you sold an asset and you held it for less than a year, you'll have generated a short-term capital gain. Short-term gains are taxed at higher rates than long-term capital gains. Second, when selling an asset for a loss to offset your gains, you need to keep apples with apples and oranges with oranges. By that, I mean short-term losses are used to offset short-term gains, while long-term losses are used to offset long-term gains. And lastly, don't let your tax bill drive your whole strategy. It's generally a bad idea to sell assets strictly to harvest a tax loss, especially if those assets still belong in your portfolio. No one likes paying taxes, but ultimately your goal is to build and preserve wealth. Make your investment decisions with that goal in mind. We can work together to identify the right time to liquidate underperforming investments if and when that makes sense for you. The bottom line is tax loss harvesting can be a savvy way to reduce your capital gains taxes, but it needs to be coordinated with your overall planning. Do you want to think it through together? Hit reply below and we'll schedule a time to talk. This is a time-sensitive move in that it must take place before December 31st. So don't think too long. Happy holidays.